Welcome back to the Investor Professor podcast. This is Dr. Ryan Peckham, and this is episode 164. On today's episode, we're going to talk about how to recession-proof your portfolio. We're going to discuss some strategies that you can use to kind of tailor your portfolio if the economy does go into a recession, depending on what your age is, what your portfolio looks like, and then also how you can use a recession to improve your portfolio overall and turn it into a good thing and not something to be so scared of. So, as always, get your mind right and let's get to work. Hey, 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 hey. You draw this. Well, welcome back to the show, everybody. Thanks again for joining me once again. I've been thinking about doing an episode like this for a while, and I thought that this would be good timing to talk about that. Won't have an episode next week. Leave Wednesday for the London Marathon, so I'm super excited about that. That'll be occurring next Sunday. So when we get back, Cameron and I will do an episode where we discuss and break that down. But I will be posting a lot of stuff on Instagram this week, so that you can follow along. But I wanted to do an episode on a recession because there seems to be so much fear, there's so much unknown. And so then it's like, all right, well, let's just break this down and discuss like what happens to the stock market during a recession, what you can kind of do to limit the damage, and how you can actually position your portfolio to be better off after a recession comes and goes. And so I know that seems like a lot, but I think educating yourself on how this occurs, what are some of the signs to look for. So we're going to talk about some of the economic indicators that you need to be aware of and look at. And then obviously, like, how do you prepare for this before it happens, which is what is so key, which is why the timing of this episode is when it is, because nobody has said there's going to be a recession. We don't know if there's going to be a recession, but obviously we know that there's been a lot of impact that the tariffs have already had on the market. And so it's always good, whether we go into a recession or we don't, to have the playbook ready before it happens. And so the big key of here is just kind of seeing, do I need to get defensive? Do I not? And so what is the actual definition of a recession? Well, a recession is, by definition, 2 quarters of slowing GDP growth. So gross domestic product, you start seeing that slow down. Now, obviously, how much it slows down impacts how, rough the recession is going to be. When we have 4 quarters of slowing GDP growth, that is called a depression. And so you'll hear sometimes it says, it's a recession until it happens to you, and then it's a depression, right? And so it doesn't always impact every segment of the economy the same. And so you have to kind of be aware of that. I would think that most people who are in real estate have had a tough time over the last 18 months, even though the economy as a whole hasn't been in a recession. So you can have certain segments of the economy going through things where the U.S. economy as a whole isn't necessarily in a recession. Now, in 2008, 2009, they call that the Great Recession. And again, economists and definitely politicians don't like throwing the word depression out there because people really start to worry when that happens. And so that investor sentiment, consumer sentiment, what are the expectations that investors have or consumers have? It impacts how they make purchasing decisions. And so the optics of these is very important when you see that. So when you look, the average recession has had the stock market, and when I say stock market, I'm talking about the S&P 500, the average decline has been about 31%. Now, these have ranged from 18% to 55% for recessions. The Great Depression saw the market fall 88%. So let's hope we never see that again. But about 31% is the average. And at the low this year, the S&P 500 had already fallen 19%. And so we've already seen a big pullback this year on that expectation. So when you look at the leading indicators of a recession, one of the leading indicators is the stock market. And the reason for that is the stock market anticipates company earnings getting bad before it actually happens. And that is an important thing to note, because when we start talking about the other half of this, like when is it an appropriate time to buy stocks, it's going to be when it looks the darkest and the numbers look bad, but the stock market starts looking ahead and saying, okay, these are the worst, earnings numbers we're going to see. These are probably going to get better. And then all of a sudden you start having people buy. So the stock market starts selling off, which is what you've seen earlier this year. They start selling off in anticipation that company earnings are going to start to deteriorate. And this is timely because right now we're starting to see companies report earnings. And on some of those earnings calls, they don't know, they're unsure of the guidance that they're going to give. And the guidance is, how do companies expect the next quarter to be? Do they see growth? Do they see it slowing down? Well, a lot of these companies are basically saying, if tariffs actually go through, our numbers are going to be this. If tariffs don't go through, our numbers are going to be that. And so there's a lot of confusion out there, which does offer opportunity. So we'll get back to that. So a couple other leading indicators are going to be the housing market, bond yields, which we saw go crazy. Cameron and I talked about that last week, which is one of the reasons Trump put a 90-day reprieve on the tariffs. Inventory levels. Are companies expecting to sell less? So they bring those inventory numbers down. And then manufacturing numbers. Are manufacturers actually producing things? Some of the lagging indicators are going to be GDP, which we discussed, unemployment. What does the unemployment rate look like? The unemployment rate is so key, because if people don't have a job, they're not able to spend money. It's also very hard to have a recession if people have a job, because they can still make their house payment, they can make their car payment, they can do all of these things. So it is hard to have a recession if unemployment stays low, which is what we saw happen in 2022 when everybody expected us to have a hard landing and we didn't have a recession. So, and then obviously inflation is another one. And so those are lagging indicators. Also, the length of unemployment that somebody might have. How long is somebody unemployed if they do lose their jobs? And so that's kind of key here. We have DOGE, letting people go of government jobs. A key thing is going to be looking, do they find another job? Do they find a replacement? Can they go back to work in the private sector? So that's another question that economists are asking. And so when you look at these, those are the key metrics that economists are going to be looking for. And so, again, it's not a perfect science, which is why, the data lags. So by the time they come out and say we're in a recession, you're normally halfway through it. So let's talk about your portfolio. Let's talk about companies that are going to be that are going to be impacted the most if there is a recession. Well, stocks that don't pay a dividend are going to be impacted, because in a recession, if you're going to stay invested, you want to get paid to wait, right? You want to get paid to wait it out, have some kind of return coming into your portfolio, so it's not just dead money. And so companies that pay dividends, because as those stock prices come down, that dividend yield goes up, which means you're making more on your money. And so that kind of acts as a parachute. Investors will come in and they'll say, man, this stock normally pays a 3% dividend, but now because the stock's come down, it's paying a 4% dividend. And one of the misnomers is that just because a stock drops means that the dividend's going to drop. That is not the case. The price of the stock does not impact the dividend that the company is paying. So you want to look for that. You want to have companies that have low debt. Remember, just like you in your personal life, if you take on a lot of debt, you are committing future income to that debt, which is the same thing with companies. But if companies have taken on a lot of debt and they don't get the sales that they were expecting, it's going to take more of their cash to pay down that debt, which allows them which prevents them from having the ability to do other things with those funds. So we want companies that have low debt, high cash flow. Companies like AT&T, Verizon, Consolidated Edison, other electricity providers. That cash flow that comes in on a daily, monthly basis is good, and they have high dividend yields as well. So companies that don't pay dividends, we got to be careful of. Companies that are at high valuation levels, so high PE ratios, which is price over earnings, high price to sales ratios. So those high growth stocks where we're expecting their earnings to be sometime in the future, those are going to be stocks we got to be careful of, because if they miss on their earnings, the stock's going to get crushed. And we saw that happen in 2022 when the Fed was raising rates. So that would be a company like ServiceNow, who looks like the future for them is going to be great, but the stock's at a high valuation. They're an AI stock, and they've done well on earnings, but if they slip, their valuation's so high, there's going to be a lot of investors who are like, man, I'm going to wait for this to come in. So depending on where you're at in your life cycle, how long you have left to be invested, you can be pretty aggressive. So somebody who's older, who needs to live off the income of their portfolio, they need to have dividend-based stocks that are kicking off income. And if it's income they need over the next 6 to 12 months, they probably should have a cash position that is invested in CDs CDs, treasuries, some short-term fixed income instrument that is going to provide them with, the cash flow that they need on a short-term basis. And they need to stay invested for, some of the growth stocks for the next 5 to 10 years, because they're going to need growth later on, even though they need cash flow today. And so this is much different than it would have been if we would have been having this conversation in 2018 or 2020, when interest rates were basically zero. So now interest rates are higher for now. I know there's a lot of pressure to lower rates, but for now rates are higher, and you can get a CD paying 4%. Which is, if you need that cash flow over the next year or two, that's a great alternative for you instead of having to put it into the stock market. Now, if you're younger and you've seen the stock market go up the last 2 years, where we had a 20% year in 2023 and a 20% year in 2024, and there's some investments that companies you wanted to be invested in that you feel just kind of got away from you, now's the time for you to have that top 10 list of companies you want to invest in, and you need to start tracking them and thinking about being able to build a position in them. And so this is when recessions also provide you opportunity to be able to get into companies that you maybe thought you wouldn't have been able to get into. So I'm going to give you an example of some of this mispricing. And these are both companies that I like. But Costco, for example. Costco has a forward PE ratio of 55, which for somebody who just sells normal goods, 55 is pretty high for Costco. I mean, compare that to Walmart. And this isn't the point I wanted to make, but to compare it to Walmart has a forward PE ratio of 35. Now let's go look at the high growth stock NVIDIA and see what its forward PE ratio is. Well, its forward PE ratio right now is 22. Which is extremely low for NVIDIA. There's no reason NVIDIA should be lower than Walmart or Costco. But it is because of all the political risk that's out there currently on NVIDIA, right? Not being able to sell chips to China. How's that going to impact their earnings? I'm not saying that NVIDIA is a clean investment and they don't have some issues coming up. But what I am saying is that NVIDIA over the next 10 years is probably going to be able to figure some of this out. Now, we could have some of the mega cap techs, the Meta, Amazon, those companies, they could reduce their spending in capital expenditures. Their highest CapEx spending right now is on those chips from NVIDIA to build out AI and the data centers and those things. So Are they going to reduce that? Maybe. Is it going to be dramatic? I don't know, because nobody wants to be second in that race. I mean, it's not like, the future, we move forward. We don't look back, right? So if you want to have, those earnings in the future, you got to spend and you got to invest that capital today. So I look at NVIDIA, right now it's $101.49. Its high was $149. So it's already dropped by a third. And so at some point, you have to say to yourself, is it worth the risk? And if you do invest in it, you have to be committed that depending on a recession happening and the market going lower, that you're going to be able to invest a little bit more. But you could start a position here at this level and start to kind of commit to it over the next 3 to 5 years. And that is one of the kind of the key things that you have to remember, is that so many investors, traders, I use the word investors loosely, but there's so many participants in the market today that have very short-term thinking. And so they're thinking about the next 2 to 3 weeks, 2 to 3 months. And if you think about the next 2 to 3 years, 3 to 5 years, if you make decisions based on that and you don't stare at the numbers every single day and you commit to certain companies, you can do well. So the decisions you make today are going to be the reason that your portfolio does well 3 years from now. So don't forget that. So if you're younger and you've wanted to start a portfolio, now's the time that you have to start thinking about, okay, some of these companies have come down a lot. Who is it that I want to be invested in? And so the same thing, if you have weak positions in your portfolio, those are stocks that maybe haven't performed well, maybe haven't done as well as you thought they would. Now's the time where you can sell those positions, raise a little bit of cash, have that cash available for if the market does go down a little bit more, and then be able to deploy it into better companies that you think are going to change the world over the next 5 to 10 years. And you can basically kind of move your portfolio up in quality of companies because you're getting a better deal than you thought you were going to get, right? So another one would be Amazon, which Amazon has gone from $240 a share, and right now it's $173. And so again, it's like, geez, okay, well, Amazon's probably going to be around. So again, that's why it's so important for you to have a list of companies that are kind of your short list of companies that you think you want to be invested in. And then you need to start tracking them. And it doesn't mean you got to go invest it all at once, or, you got to make the decision tomorrow. But it does mean that you need to have more of a conscious effort of this and be cognizant of this so that you don't miss it. There's been a lot of times where 2020, 2018, 2022, where the market has fallen and has rebounded faster than most have thought it would have. And so that could be the case here. So we always, have this fine line we have to walk where we think we're going to be able to invest in these companies for a lot longer than we think we're going to be able to invest in them low longer than maybe we really have the shot to. So instead of being worried about a recession, think about, oh my goodness, I'm going to get to spend the next 9 months investing in this company and building a position while it's low. And so don't take it for granted. It's there's a saying, never take a recession for granted or anything like that, as far as like being able to invest in high quality names. That is when the real money in the stock market is made, when you can buy companies at a great price when other people are throwing them out, and you can sit on them, be patient, and wait for them to recover. And again, that's why it's important for the money that you're putting into this, that you're investing, that you're not going to need it. And if you do need some money, you go ahead and you take care of that, and you have that already built into your portfolio. So these are the things where we don't panic. Panic is not a strategy. Panic is not a strategy. So, when it comes to investing, you have to know that there's going to be some good days, there's going to be some bad days. Most of the time when we do have a recession, the stock market does not bottom in a week, a day, a month. It actually takes about 12 to 13 months for the market to bottom. So there is a process involved with that. And then it takes about another 9 to 12 months for the market to recover, depending on how serious the recession is. Now, this one, all this volatility has come based on tariffs and some political stuff. So I don't think that, this is all on the expectation that tariffs were to go into place and that they would stay in place. And so if something like that is causing this great economic harm, it's going to be a long shot that it would actually stay on to put that kind of pain on the market for, month after month after month. I mean, I don't know how accurate these are, but some of the studies I've seen show that if the tariffs were to stay on as proposed, they would reduce global demand 10% every single month. So that's not something that's sustainable. So my point of that is that you are getting some opportunities on some very good, high quality companies. There's no guarantee how long that will last, so you better take advantage of it. But if it lasts longer than we think, make sure that you give yourself kind of the backdoor opportunity of being able to add capital and to improve the positions, but at least be okay with where you're starting the positions and look at a price and be like, hey, that's a price that I'm comfortable owning this stock at. If it goes lower, it goes lower, but at this price, I'm okay with it. Like I'm okay with this current price that I'm getting. And so look for high quality names, look for things that pay a dividend so that you can get paid to wait and you can have that dividend reinvestment. Make sure you turn that on in your portfolio so that the stocks continue to reinvest that dividend, especially while prices are low. Look for some growth stocks that might not pay a dividend, but allow yourself the opportunity that if they do get beat up on earnings, that you're able to buy more. I think that this earnings season probably isn't going to be that bad because this is reporting January, February, March. Yeah, January, February, March. And so the numbers look okay, but it's the next 3 months that I'm worried about where the consumer actually changes their buying behavior. And they, and also if the expectation is if you expect prices to go up, you're going to buy now. So we saw that this week, the retail sales number was actually elevated. And my worry is that that's just people going out and buying things that they thought they were going to buy over the next 6 months. So they buy them today because they think they're going to be more expensive in the future. And so we're already seeing some companies make some decisions. You've seen the airlines where they're taking off flights. They're reducing the number of flights because they're not seeing the demand for flights like they saw last summer. So consumers are already starting to adjust, and we'll see how that impacts companies. But recessions, while not fun, are part of the business cycle. And if you use them properly, you can actually improve your portfolio, come out with a stronger, better portfolio on the other side. So keep that in mind when you feel that anxiety come up and you're worried about, the prices and the stocks and your overall portfolio value, because it does, that people get tensed up. Nobody likes to see themselves lose money, even though if it's on paper and they actually haven't sold anything. So just kind of keep your wits about you, and you can do quite well when everybody else is panicking and their emotions are betraying them. So I hope this has been helpful for you, and we will see you next time. We'll see you after London. Thanks, everybody. This podcast contains general information that may not be suitable for everyone. The information contained here should not be construed as personalized investment advice. There is no guarantee that the views and opinions expressed in this podcast will come to pass. Investing in the stock market involves gains and losses and may not be suitable for all investors. Information presented here is subject to change without notice and should not be considered as a solicitation to buy or sell any security. Right Our Equities does not offer legal or tax advice. Please consult the appropriate professional regarding your individual circumstances. Past performance is no guarantee of future results.